Life after life support. Well, actually, as it turns out, we're still having some life support. We learned that yesterday. Life support is still needed. So I thought I was coming up with a provocative title, was going to explain to you how tapering, really, if they were to taper, it wouldn't have been data dependent, but Bernanke gave us his word, and he was true to his word. I'm going to start with kind of a global overview, talk about the US, Japan, Europe, you know, the important places in the world, talk about some emerging markets. I'm going to talk about something KPMG does very well, which is megatrends, and its analysis of the global economy with a very long, forward-looking projection. Central banks were trying to achieve something with all of this extraordinary monetary measures that they undertook, and it was different in different places. In the US, we were trying to improve the level of employment. In Europe, they were trying to stabilize the euro. They were trying to improve debt to GDP ratios. And for a large part, this has begun to be achieved. And so we have higher collateral prices that allows banks to lend a little bit more. We have some virtuous circles reinforcing the growth story. And our worry now is very, very different than it was a year ago. A year ago, what we were worried about is, where's the next crisis? And now what we're worried about is, what is the rate of growth? Those are two very different things. And it certainly doesn't mean that we don't have to worry about problems or crises on the horizon. It just means it's not our prevailing concern the way it was for so many years, and the way it still was even a year ago when Cyprus was on the verge, when we didn't know if Portugal was going to leave the EU and that was going to cause problems. We're certainly in a different situation. If you wanted to just know my entire presentation on one slide, this is it. Basically, we have a situation where developed markets are driving the global economy. This is a shift because after the crisis, it has been emerging markets. We have a situation where we are facing long-term challenges. These are structural challenges. We're still experiencing deleveraging in the US and in Europe. It doesn't appear they're going to go for any deleveraging in Japan. And we have a bunch of risks that are out there. And I call these known knowns and unknown, or known unknowns. So we know that demographics presents a headwind to growth, but very few people have come to terms with this in a significant way. We know technology is a threat to some businesses and a huge benefit to others, but there's going to be still a great deal of displacement. Technology and productivity improvement is fabulous, but it is in part causing this hollowing out we're seeing in the developed world of middle-income jobs and a middle class. When you look at a manufacturing floor now, you don't have a lot of people. You have a lot of very high-tech robotics. And then there are bigger issues like water scarcity. Water is not a properly priced commodity. It's basically a public good. We don't pay a market price for it. God forbid we ever did. That would be quite a shock to our economic system, to our food supply, to the cotton in my shirt. And we also have the issue of climate volatility and its impact on urban areas that are located in low sea level parts of the world, like New York, for example. So when we look at the global economy, there's really 4 states. There's only really 4 places we can be. We can have low inflation and high GDP growth, which do I have a, oh yeah. All right, this is where we were, Goldilocks. Remember that? Where multiple asset classes do well, where there's a lot of beta and therefore there's also a lot of alpha. Funny how that happens. And then we have a problem with this quadrant though, which is that usually we become lulled into thinking that there is a paradigm shift and we accumulate a lot of debt. Interest rates are low, inflation is low, everything is good, pop the champagne, and that's what got us here. This is what I call the beggar thy neighbor box. We have low inflation, we have low growth, we have a great deal of government stimulus. We did not, or have not yet, experienced trade wars, which was a very big concern that we would go back to a situation like Smoot-Hawley, where we would impact trade tariffs that were very damaging to global growth. We didn't do that. In fact, we are in the process of negotiating two very important trade pacts, the TPP, Trans-Pacific Partnership with Asia, and a European trade pact. And from what I hear from my contacts in DC and in Europe and Asia, those are going fairly well. And so we did not have that, but what we have had is a currency war. We have had competitive devaluations. Competitive devaluations are disinflationary or deflationary. And this is a very pernicious problem. Unfortunately, we also have a game theory problem here, because each individual country is very incentivized to devalue their currency first. And so nobody is incentivized to say this is a bad idea, although we tried. Japan promised it would not, I think it was 2 or 3 G20s ago, they promised they would not devalue their currency. And honestly, we haven't gone above 100. So more or less since then, they've kept their word, but that was after they had a 25% devaluation. Now, let's talk about inflation, because that is something that obviously everybody is very concerned about, or concerned that it might happen. So there's two kinds. There's cost push and demand pull. Stagflation, cost push inflation, is when you have a commodity shock, and it is usually not assisted by other things in the economy. In the 70s, it was assisted by rising housing prices, and those people that could get jobs were experiencing rising real wages. So the commodity shock was assisted by other things in the economy. And we're not in that situation right now. That doesn't mean we couldn't have cost push inflation. We also learned a lesson from that time period in terms of price fixing. I don't think that we would go there again. So there's some policy mistakes that we made, and we have hopefully learned from them. Then we have another kind of inflation, which is the normal kind of inflation that causes the business cycle to occur in the first place. It's demand pull inflation. Demand pull inflation occurs when people start to earn more money, their assets are doing well, they want more stuff, they start to demand more stuff. Companies then start to expand capacity. But before they can do that, that's not instantaneous. There's a lag. Prices start to go up. That higher price usually causes a pullback in demand, but we've already had the capacity expansion, so we get a downturn. Normal business cycle stuff. And we are not in the normal business cycle stuff. And part of that is secular, and part of that is cyclical. So if we just look at the global economy, we can see that we're really not doing very well. There's really not a lot of blockbuster numbers here, and even 7.5 for China is considered low. And I'm going to talk a little bit more about China going forward and give you some data points that suggest that China is not going to be able to grow at the same rate that it's been growing. But save for China on this list, this isn't looking super great. Neither, by the way, is industrial production year over year. PMIs are doing, look, in the US we're doing the best. Japan is starting to pick up. You're seeing the UK have a nice turnaround, and as I said, growth is really coming from the developed markets now, not the emerging markets. Okay, so here's a more historical look at the PMI readings. And you can see that the US is the strongest. This is the services reading, but it's still pretty tepid. We're not getting really strong services spending in the US. It's still very below trend. It's running at about 1% a year, whereas goods spending is running at about 2.5% a year. And actually, it's the services component that really makes up the bulk of consumer spending. It makes up 70% of consumer spending. Okay, so manufacturing is doing much better. We're seeing fairly strong readings and upward trends in all of these key developed economies. And it's been the bright spot, and it continues to be the bright spot. All right, so what's happening? I mean, are we going to get escape velocity or not? Right? That's the big fear with growth being where it is do we have enough growth to get escape velocity? And we're either usually in a vicious circle or a virtuous circle. If we were in a vicious circle, these triangles would be flipped. So we would have a falling tax base, and we'd have increasing transfer payments. But because we have moved out of being in a recession, we're starting to get a few more jobs. That's leading to more income. That's helping buttress housing, which is helping to buttress household net worth, which is leading in part to some more consumption. That consumption is helping firms make investments, which is then leading to more jobs. So we're in the virtuous circle, but the big question is, do we have escape velocity? Are we growing fast enough that we're not risking going back into recession? And when we look at the jobs market, although we have been growing, and we've been growing at 200,000 a month, it is not enough to account for population growth. And in fact, if we look at the unemployment rate, we see something very troubling happening. We see the mean duration of unemployment is at an all-time high. So we're hovering at about 37 weeks now. The high during the 1980s, the double-dip recession of the late 70s, early 80s, the high was 25 weeks. So there is something structural happening in our labor market. Another piece of evidence that there's something structural happening in our labor market is the labor force participation rate. I am not showing you a graph of unemployment because A, there are several different measures of unemployment. B, you have all seen them before, so I am showing you something different. This is the civilian labor force. This is the employed civilian labor force. You can see that the difference here is the unemployment, right? And that this peaked during the height of the recession, after firms got around to laying people off, and this is when we had the highest unemployment rate. As this has improved, as we've had more jobs, we have started to see an improvement in the unemployment rate. And we've started to see something very good recently. We've seen an increase in the participation rate. Now, if you are an economist and you're used to looking at data and finding pattern recognition, one of the things you will notice about this graph, or this line, is that the seasonal adjustment has changed. This is really important. In economics, this is what we call a structural break in the data. It means the past data is not going to help you very much predicting the future. We've had a structural break in the data. Something different is going on. All right, so a couple things about this. One, if you are not already familiar with and have begun and started reading or have all along been reading Janet Yellen's speeches, you should start. Not only is she very smart, she is going to be our next Fed governor in all likelihood, and she understands this problem. She understands some of the limitations of Fed policy. She may not be the uber dove that people think she is. Okay, now looking at the consumer. One thing that has really hurt the consumer is higher gas prices, and this has been the case for a while. So when gasoline store sales as a percent of total retail sales exceeds 12%, we estimate that there is pressure on the consumer. They don't have as much disposable income left to spend on other things. So this is something that's hurt the consumer. This is not something the Fed has very much control over. They can help increase wages, but all that means is you're getting more absolute retail sales, right? So this is a problem for our economy, and it certainly hurts the amount that people consume. Now, the one thing the Fed can help with is mortgage rates. And we all know rates have gone up, and we all know that this is part of what is causing a little pullback in housing. But when we look at it historically, and we just look at total compensation, and we look at mortgage interest as a percent of total compensation, you see something very interesting. We are at a historic low. And so this suggests that the assistance of lower rates that the Fed has been able to give to the economy has been exceptionally helpful to households, but not all households. Only the households with people who are employed and are wealthy enough to pay their mortgages. So remember I talked about the structural break in the labor market. Another thing, and earlier I mentioned how technology was hollowing out the middle class. We are starting to see a very significant problem in the US, which is that not everybody gets, well, we knew this, and not everybody should own a house, but the fact is this only affects a certain percentage of the population, right? This doesn't affect everybody. So it's part of the reason that the averages are not telling you the whole story. But if you look at what's happening just with housing and with home ownership, the mortgage interest as a percent of total compensation is at a historic low, despite this recent run-up in interest rates. Okay, and you can see that this has helped spur investment. This is housing starts, which have had a little bit of a pullback. These are basically two ways to represent the same number. So private residential investment contributed about 40 basis points to growth in the second quarter. It is a significant part of our GDP. It also has multiplier effects because when houses are built, there are all sorts of tangential jobs that get created. And it's got, aside from infrastructure investment, one of the highest multipliers of anything in our economy. But the increase in housing prices that we've seen since the recession, coupled with very slow wage growth, means that the affordability index is falling. And you can see that that has corresponded to a drop-off in single-family home sales. So happening at the same time are higher mortgage rates and a pullback in housing demand because the price has gone up. This is something that the Fed is paying attention to. This is part of the reason that they did not taper. This is part of the data that they're looking at. Okay, this just says that we've had a bounce off the bottom. We're not going to be having double-digit growth in home prices. We're going to move to something more like a 5% rate over the next several years. I don't think we're going to see housing turn around and crash, but we're certainly not going to see the growth off the low base that we have seen for the last couple of years. Okay, let's talk about inflation. There hasn't really been all that much of it recently, and there's a lot of good reasons for this. Part of it is what is going on in the labor market. We don't have wage growth. Part of it is what is going on in capacity utilization. When capacity utilization is under 80, it generally is not putting pressure from a capacity constraint perspective. It is not causing the need to build new factories or to expand, and so it's not putting pressure on inflation. And in fact, forecasters have forecast very low inflation. Now, most people in this room probably don't put a lot of value on what forecasters say, right? Except that in the case of inflation, expectations are really, really important. Let's say you're running a factory and you need to buy some more inventory. And you're going out there and you're going to decide whether or not you're going to buy inventory. You expect that maybe what might happen is that the value of that inventory is going to fall in the next 3 months. Are you going to load up on inventory? No, you're not. You expect prices to fall, you're not going to buy any more inventory. If you have negative price expectations, it is self-reinforcing, and it causes negative price expectations. If you have positive price expectations, prices of that inventory may go up, you might as well buy it now. It's going to go up in price, even if just a little bit. It's going to make sense to buy it now. There's going to be demand for it. You stock up on your inventory. When you have a collapse of the inventory cycle, like we did in the fall of 2008, fourth quarter of 2008, you saw inventories and global trade collapse, fall off a cliff. And it was because everybody was afraid that prices were going to collapse. And it was very, very bad for the economy. So when forecasters expect a certain inflation rate and they expect it to be positive, this is good. If people expected it to be much higher than this, that would obviously not be good. But this is one forecast that is actually correlated to the outcome of the data point. Okay, so let's talk a little more about this. There's the disinflation camp, and there's the inflation camp. The cry of the inflation camp is that we're inducing all this monetary stimulus, and of course we're eventually going to have inflation. And the problem is that we're not seeing velocity of money grow, and we're not seeing M2 grow terribly fast. Of course, that could turn around on a dime, and what if that does happen, and we have all this extra money sloshing around in the system? I think the Fed can actually handle that. The thing that's more difficult, I think, is what is, again, going back to this structural break in the labor market. So there is an economist here in Chicago called Robert Gordon. How many of you have heard of him? Okay, good. So Robert Gordon wrote a very important piece last January, so 2012, where he talked about the limits to productivity growth and therefore the limits to growth. I don't actually think I have contention with that article, but part of that article and part of the work that he has been doing for the last several years has been on the labor market. And part of what he has looked at is the difference between the long-term unemployed and the short-term unemployed. And the short-term unemployed have a much lower unemployment rate and have a much shorter duration of unemployment. And they are the people, since economics happens at the margin, his thesis is that those are the people that are going to drive the inflation rate. And in fact, what he has done is he has been able to fit the Phillips curve, which has been largely debunked over the last 30 years. He has been able to fit the Phillips curve very well when he looks at the short-term unemployed. So it's inconclusive whether or not he's going to be right. But his view is that we have about 2 more years left, and if we keep getting the same level of employment for the short-term unemployed, these are the people that are either highly educated and well-paid or low-skilled workers. Those are the 2 areas where we're adding jobs in the economy. If we continue to have the same trends there, we're going to be looking at some inflation problems 2 years out. Now, as I said earlier, fortunately, Janet Yellen, in addition to being very smart, is very aware of the issues in the labor market and very aware of these structural breaks. And so if I were you, I would pay attention to both of these things and keep them on your radar screen. Now, in the disinflation or low inflation camp, there's a lot of really good arguments as well. There's global debt overhang, and there's the concurrent deleveraging that is happening and needs to still happen. There's falling wages in the developed market. There's competitive currency devaluation. There's high unemployment rate. There's excess capacity. And there is technological innovation. Now, the technological innovation is doing 2 things. It is allowing us to have higher productivity growth, and that allows us to grow at a faster rate before we experience inflation. But it is also impacting our labor market. So, as I mentioned earlier, if you look at a factory floor, it is a lot of high-tech robotics and a lot less people. There are many, many areas where this is happening. People are talking about this happening eventually in medicine. You won't need a nurse or a doctor unless you need acute care. If you just have a routine question, you have a device. You ask it a question. It can sort millions of records in a matter of seconds and give you an answer. So there is a lot of scope for reduced employment, which in theory, if Robert Gordon is not right, should reduce our inflation rate. On the other hand, he might be right, and we need to pay attention to the data, and we need to pay attention to the work that he's doing and others like him are doing. Okay, so where is growth coming from? We have government expenditure, net exports, investment, and consumption. We can see the dramatic fall in everything but net exports and government expenditure during the height of the crisis. Then we've seen government expenditure really come back. Now, this is total government expenditure, includes the state level. So we've seen both state and federal government come back. We've seen consumption actually do pretty well here. We've seen net exports really do very well. But we really need sustained job growth and higher job growth to get consumption above this 2.5% level. We need sustained and higher job growth in order to get the consumption of services to be at a higher level, because services is generally where you have the higher paying jobs. So in order to get growth, we need more jobs, more high quality jobs, and more services consumption. And this goes back to this question of do we have enough velocity in the economy to keep slipping back from slipping back into recession? And I think the really important question and difficult question to answer is, are these structural breaks combined with our debt overhang, combined with our demographics, are they headwinds that are just too large to combat? And that's really the big fear. Not just for us, but for Europe and Japan as well. Now, we have 2 saving graces. One of them is our petroleum our natural gas and energy boom. And if you look at petroleum exports, they have absolutely exploded. And in fact, our recent current account data from this morning shows us that a 2.4% of GDP current account. I think that it's very conceivable in the next 7 years, 5 to 7 years, we could get to a 1% current account deficit. This would be hugely positive for growth, adding about 20 to 30 basis points a year. So very significant growth, especially if you're only growing at 2.5%. This is a pretty significant improvement. It also helps us do the next part of our what I think is a strong growth area for the US is technology. So when you have cloud data, it needs to be stored somewhere. It needs to be stored. That requires electricity. With our cheap supply of natural gas, we are probably one of the countries in the world best situated to be a data storage hub, to be a data storage center, not just for US companies, but for companies globally. Now, talking about this technology for a second, one of the other things that I think is very important and a very real prospect is bending the cost curve in healthcare. So if you look at any of the forecasts for the future cost of Medicare or Medicaid, they all assume that we grow at the same rate we've been growing, 7 to 8% a year. So that is not really possible. Like, we are not going to get to a point where we're spending 50 or 60% of our GDP on medical care. Like, that would not fly. That dog don't hunt. So it's unlikely in the first place. But just like peak oil, I think that you're going to see this really go away with technology. We are starting to have efficacy improved because we have monitoring devices that don't even require the compliance of the person with the monitoring device. It's automatic. We are starting to have, with the advance of data and data analytics, so big data, structured and unstructured data, so both big data and structured data, the analysis is changing. So we are able to add a level of complexity and look at heterogeneous data and make projections and assumptions. This is dramatically different than looking at averages. So when you go to the doctor in general, the doctor will say, well, on average, the average person would be this, it's a bell curve, and we'll just treat you as if you're in the average. Well, we all know it depends very much on the shape of that bell curve, how many people are actually in the center, right? And so now we are getting to a point where we can have customized healthcare. So improved efficacy in delivery, improved responses because we have more data about the patient, and more customized delivery of healthcare and medicine. It's going to really bend the cost curve in healthcare. Then you add this additional component that I mentioned earlier, which is probably a reduced need for medical care professionals. Now, this is bad news for medical care professionals, but it's somewhat good news for medical malpractice insurance. It is good news for the consumers of healthcare because you have less error, you have a lower cost, you don't have to put the device through medical school. That device does not need to take out student loans in order to become a doctor. And it's really going to change the way we interact with medicine. And it's interesting, I think there's a unique unintended consequence of the Healthcare Act, and that is that a lot of companies are not offering health care anymore. It's my opinion that companies should not offer health care anyway. It completely distorts price discovery, right? Your employer is paying for your health care. You're not paying attention to how much it really costs. You're paying attention to how much it costs you, and your employer is sort of paying attention to how much it costs everybody. But you are not in direct contact with the cost of your health care. If people have to individually go out and shop for health care plans, they're going to be in direct contact with the cost of their health care. And at first, this is going to be really disruptive and really difficult. But if you get a large enough population of people purchasing their own health care, then the actuarial problems associated with the, quote, non-employer insured starts to dissipate. And you start to actually have purchasing group, individuals being able to purchase on a group pricing and group actuarial model, because the assumption about a person who doesn't have employment or doesn't have health insurance from their employer completely starts to change. So this is somewhat of an unintended consequence, and as an economist, though, I say this is actually good news. More individuals buying their own health care and experiencing price discovery has the potential to put pressure on the insurance providers in a way that has not been done since we started our system. And by the way, if you don't know why our government has it that employees offer health care, it was right after the Great Depression. We wanted to reduce inflation. We were experiencing some inflation, and we said, well, you know, we really don't want wages to go up, so instead of offering higher wages, why don't you all offer health care? And so it was mandated that companies had to offer health care, which was a completely, well, let's just say, it was an unintended consequence. And FUBAR comes to mind. If you don't know that acronym, look it up. So let's go to the Fed. I wanted to put up a picture of Bernanke and Yellen in cartoon form, but KPMG, you know, we're very, very good at compliance. And I would have had to buy the rights to the pictures, which was a nominal cost. But then if I was going to show it to a group of people, that cost multiplied. So I don't have my very cute and amusing pictures of Bernanke and Yellen, and I have to amend my slide. So that's why it's a little lopsided there. But try to imagine cute cartoonish pictures of Bernanke and Yellen at the top of the slide. And what you see here is quotes from various Fed governors. Some of them are hawkish, some of them are dovish. And here's what I have to tell you about the Fed. This is my view of what's happened. So the Fed went to enact forward guidance. They enacted forward guidance because they wanted the market to have more information. For years, the Fed has said for an extended period of time, or it's given a vague forecast of when it might change its rate policy. And we had in the market this pervasive idea that there was going to be QE forever. And the Fed didn't like that. It knew that it was problematic. It knew it was magnifying the distortions that their purchases were causing, and it wanted that to stop. So it said, okay, we're going to enact forward guidance. Yellen was actually the individual who was responsible for getting that done on the committee. She had to convince people who didn't think it was a good idea that forward guidance was going to be helpful. So they enacted forward guidance. Wasn't helpful. The market reacted like, we don't understand what you're doing, you're not increasing transparency. The vitriol, the negative comments about the Fed increased. So really it didn't have the intended consequence that they wanted. So they thought, all right, we have to convince the market that there's no Q ever, that we are eventually going to stop this. This is eventually going to work to some extent. We will get escape velocity. We will stop engaging in quantitative easing. We will stop our asset purchases. So they said to you, we are going to stop our asset purchases at some point, maybe this fall. And they also said something else that everybody decided not to listen to. What did they say? They said it will be data dependent. It will be data dependent. Everybody chose not to listen to that. The data started coming in badly. And you had people ratchet down their forecasts, but it was almost like, well, I thought they were going to taper by 10. I can't now say they're going to taper by 0. So it started off, the forecast was 20. Then it was 10. Then it was 5 billion. That 5 billion was really a 0. It's just that nobody had the confidence, or very few people had the confidence to say what's actually going to be 0. Bernanke told you that he wasn't going to do it if the data didn't justify it. The data don't justify it. If you look at some of and Lockhart's quote is very interesting here. He says, I see it as a decision to proceed, whether or not it's September, October, or December, ought to be thought of as a cautious first step. He's basically saying, doesn't matter what month we do it in. If you look at Fisher, he said, well, it has to be gradual. It's got to be very, 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 very gradual. We can't shock the market with this. Now, there's another interesting consequence of what happened. So the market thinks Q ever is over. We have a backup in yields. And now, guess what? Just through moral suasion, the Fed has a lot of power again. All they have to do is say, we're not going to do it. It's data dependent. We're not tapering yet. Yields come right back down. And my personal call is that we see 250 on the 10-year before we see 325. All right, let's look at the forward curve. So we have today, well, the other day, yesterday, before I left my office, we have 1 year from now, we have 5 years and 10 years. Now, out of the 10-year, we see actually an inversion. And I would submit to you that the Fed is actually anchoring rates out 5 and 10 years. They're not anchoring the short end of the curve. They've gone from anchoring the short end to anchoring the long end. Because these rates should probably be a little lower at the 3.5, oh, let's say they're 4. Then the long end should really be at 6. Are we really going to have an inverted curve 5 and 10 years out? Maybe. But my guess is that there's some room to make some money in here. Okay, so what's going to be an important factor in that? What happens with our fiscal debt? And we have the debt ceiling debate, we have the budget, we have sequestration. It's amazing. Sequestration was put in place because it was so onerous, they would never let it happen. Well, okay, so our Congress is so ineffective that they will choose the stick instead of the carrot. And we have sequestration. Now, my view on sequestration this time last year was that it would be the fiscal bunny slope, not the fiscal cliff. And in a way, I wish I wasn't right about that, because now we're faced again with this decision, and it wasn't that bad. So okay, it's not the really bad stick that we thought it was. Like, we could let it happen again. My view is that the iterative process of slashing 10% across the board, instead of saying you have to cut 10% but be strategic about how you do it, two very different things, the iterative effect of doing that over and over again, if this happens in a multi-year process, is pretty bad. It's not going to be, so while it was not terrible this time, and incrementally next year it probably won't be terrible, it does not help the efficacy of our government. And if we said cut your budgets, but cut them how you see fit, just cut it by 10%, we would actually have the potential to have productivity gains within the government operations. But we're basically saying that's not going to be possible. So my supreme hope, although it's not probable, is that they are able to do a debt ceiling deal and that we're not going to need to do sequestration. Now, what we really need to do is re-engage the Gang of Eight, the Simpson Bowles, and these bipartisan commissions that look to restructure our tax code, that look to reduce costs. And if you look really, well, this is tax receipts. And I just took April '82. I picked a random year many years ago versus now. And there's a couple interesting things that you'll notice. One is that we did not get as much money from individual income taxes, and that's because we got a lot more money from Social Security taxes. Why is that? Because we had a lot more people working, right? So this is partly a structural issue. Demographics. Remember I said the known knowns? Demographics is the most ignored known out there. We don't want to pay attention to it. So we have a fewer percentage of our tax dollars coming from Social Security because we have fewer people paying into Social Security. We have to therefore get money from somewhere else. Well, guess what? We reduced excise taxes. So that's probably a good thing, reducing excise taxes. We have fewer percentage of our money coming from excise taxes. We reduced corporate taxes. Well, that's probably a good thing because really we don't want our corporations to be non-competitive. We want businesses to want to come to the United States and work and employ people and add to our GDP. So guess what gives? Personal income taxes. All right, let's look at the cost, the outlays. So really compared to defense and Social Security, the other outlays are rounding errors. Most of them, most departments, it's below 1%. So aside from education, which receives 5%. So, and you can see that during our escalation of activities in the Middle East, we've spent more money on defense. And during the combination of the recession and the increase of retiring baby boomers, we've spent more money on Social Security. As I said, one surprise on Social Security could be bending the cost curve in healthcare, but that's not going to happen next week. It's probably not going to happen next year. We're looking at 3, 5, 7 years out, and it's not going to happen overnight. So we still have this issue. And in fact, I have a slide later which shows that based on our structural obligations, our budget deficit and our debt start to increase in 2015. So this is not, we don't have a lot of runway here to pay attention to our demographics. We also don't have a Congress that's particularly cooperative, or proactive. And quite honestly, we really only have ourselves to blame on this one, right? We're all suffering from collective amnesia. Yeah, it's a good idea to raise the retirement age, but not on me. No, I'm the guy who's 1 year younger than me. Raise his retirement age. Don't raise mine. Well, yeah, okay, like we need to, not everybody should get Social Security necessarily. Maybe we should have means testing. But no, not on my tax bracket. On the tax bracket above me, right? So we have voted in a series of people who will act in our own short-term self-interest. And this is a collective action problem. It's a very big game theory problem. The solutions are hard to find. But unless we find some, we will be faced with a big problem. Okay, let's switch to Europe, because I want to make us relatively look good. All right, so we've had an increase in growth in the second quarter. My cautionary note is beware of weather effects. The weather was very bad in the first quarter in Europe. It reduced consumption. It reduced construction spending. Those are two areas where you saw increases in the second quarter. So you had this bump up in GDP. It's unclear how much of that is sustainable. It could be some of it is pent-up demand. So I would expect to see slightly lower growth in the third quarter. However, there's some events happening. We're bouncing off the bottom in Spain. We're bouncing off the bottom in France and Germany to some extent. Ireland has gotten itself together. Interestingly, Italy is a country that a lot of investors are looking at. There are companies that, where there are opportunities that are very well run that people are looking at in Italy where they just wouldn't have had an opportunity to look at 3, 5, 10 years ago. So I think you probably know that there's been a lot of distressed debt funds raised, ready to pounce in Europe. So there is some scope for things getting better in Europe, but they still have this very big problem. They don't have a pan-European FDIC. So effectively what that means is money doesn't move freely across borders. Neither do people, right? So they don't have a harmonized inflation rate. And in fact, one of the things that's getting better is you're seeing inflation rates start to converge. So we don't have this problem in the US, right? Like banks in Kentucky don't receive different treatment than banks in Nevada, for example. You wouldn't say, well, the banks in Nevada are so much worse than the banks in Kentucky, so we won't move money between these states, right? But you do have this problem in Europe. And that's why and that combined with the lack of labor mobility is why you've had these very wildly different inflation rates between the countries. Monetary policy has been and is still being run for Germany. And so it caused the bubbles during the time when Germany needed low rates, and it's causing them to have a hard time coming out of this during a time when Germany needed higher rates. We're starting to see some convergence in inflation. I'm not sure how long that lasts, but these two issues make it very, very hard for the ECB to do its job. And so I think we will have extraordinary measures in Europe a bit longer than we have them in the US. All right, let's talk about Japan for a minute. Japan's an interesting preview to several movies that are coming soon to a theater near you. China and its demographics, the US and its debt. So you can see here that we've had the GDP deflator, which is like it's an inflation measure. It is not like CPI. The way that it is different from CPI is that it takes into account substitution effects. And so you can see that it has been negative. Now the CPI number has been a little bit better, but not really very strong. And you can see that so this is their number of bankruptcies. They had the Big Bang and the restructuring of the banking system. But you can also see that this crisis, people talk about Japan's lost decade. If you're counting, it's been at about 2.5 decades by now, right? So finally comes along Prime Minister Abe. He does Abenomics. His objective here is to inject more money into the banking system that will be new loans to real sectors. It will increase the velocity of money. It will increase the money multiplier in Japan. That will ultimately increase consumption, and that will ultimately help them get out of their disinflationary, deflationary problem. Now, what does this depend on? It depends on confidence. It depends on confidence that Japan is not going to default on its bonds. That's the only way the real interest rates fall. And they need to lower real interest rates. So in order to do that, what do they need to do? They need to increase inflation expectations. People need to expect prices are going to go up. They need to buy it today because next month, next quarter, next year, it might be more expensive. Whether it's a car, a dishwasher, inventory, people need to buy it now. And this means that it's all based on confidence. Now, so far, so good. As I say, some Hail Mary passes really do work out. So it is possible that this will work. We've had 2 good quarters of growth, but you can see their growth has been very, very spotty. Now, we can explain some of this by exogenous factors. So the tsunami that occurred in March of 2011 really shocked Japan's economy, and it actually shocked the global economy. People were acutely unaware how much their supply chains were linked to Japan. So we had negative growth in Japan for 2 quarters. We had a big bounce back quarter. And then we had a not so great quarter, barely positive, a little bit of positive, and we slipped back into recession. No escape velocity in Japan. The question is, are we starting to get escape velocity? And it's looking like we might be getting there. So we have to wait and see, but it's looking better than it's looked in a long time. Okay, just switching gears to emerging markets. We've seen a big fallout in emerging markets. They are not driving growth. We don't expect them to drive growth for another year to 18 months. But there really isn't this huge decoupling that people have talked about. And that is because the export cycle in emerging markets is very linked to the CapEx cycle in developed markets. And so while there were stimulus packages that were enacted in emerging markets, and specifically China, that helped propel global growth after the financial crisis, these markets are very, very linked still to the developed markets. That's who their end users are. And when you look at an economy like China, their services industry is the lowest of all emerging markets. So the deal with China, there's some PMI readings. Okay, so China's had amazing growth, right? And they've had amazing growth because people have moved from the rural economy and farming into manufacturing. What they haven't done sufficiently is they haven't moved from manufacturing to services. Now here's the rub with the services economy. You have smoother growth, you have less volatile business cycles, but you also have lower growth. And you don't have the ability to control it centrally. So it's much harder to throw money at a services-based economy and see results. If anybody doubts this, just look here in the United States. This is our big complaint about the Fed. Are they really doing any good? Does it make any difference? And so China is a command economy. They want to control the level of growth. The Standing Committee wants to remain in power. They have a whole bunch of systems and incentives in place at the local level to drive their goals at the central level. And so what you notice about this is that the capital stock required over the last, let's call it 15 years, has been much greater as a percent of GDP to get the same amount of growth, or to get less growth. You can't keep throwing capital stock at a problem once you've reached overcapacity. It's not as effective. Now, the other thing that's happening in China is they're starting to have a negative labor force. So their labor force is actually falling. So the demographic problem we have in the United States is that the rate at which our labor force is growing is declining. And I'll show you a graph. We'll get to it. But what this means ultimately in China is they're having lower total factor productivity. So remember earlier I was talking about Robert Gordon and lower productivity, and how lower productivity means that you have a higher, you have a lower GDP capacity, but you also have a more trigger hair threshold for when inflation starts to curb back your growth. So China has some issues, and it comes into this risk section because the markets and the global economy has psychologically become very dependent upon China. Although I will point out, Japan when it was in its heyday, it was 70% the size of the US economy. And during its 2.5 lost decades, you really haven't had a whole huge amount of worry about the fact that Japan isn't growing because other economies have come in and taken its place. And so even if we see this pullback in China, it will impact global GDP to some extent, but what we don't know is what will take its place. Is there something that might come along and take its place? In the 90s, if I had told you, Japan, don't worry about Japan, China's going to come along and take its place, you probably would have thought I was smoking something. So, as I said, KPMG does a lot of really amazing work around megatrends. And I'm just going to talk about demographics. I already touched a little bit on technology. We look at social values and ethics and the environment, but just going to demographics. So this is China. Their labor force starts to contract in 2016. It contracts pretty dramatically before it contracts less. That is a really, really bad situation. So as I said in the US, this is our labor force. It's still positive. It's above 0. We just grow less slowly before we start to grow a lot because of the Latino lift. So this contraction of their labor force really is problematic for China. It means their potential GDP cannot grow as much as they thought. Now, I just gave a speech on this entire topic. There are a bunch of scholars that are looking at their potential output. The range in the worst case scenario is that their potential GDP by 2025 will fall to something like 4.5% to 6%. By 2030, it's going to fall to 3 to 4%. So China will continue to experience growth that's much bigger than the developed economies for the next 10 years, but then it gets a little dicey. And when you think, so I did an interview earlier today, and I was asked a question that's probably on the mind of a lot of you. Just check my, all right, well, I'll make this pretty quick so that we can have a little Q&A. I was asked if China would be the next reserve currency. So how many people think that's a good idea or think it's probable? Just raise your hands. Possible. Okay. All right, not the majority of you. All right. So either you're scared to raise your hand or you really don't think it's possible. I got you back there. All right. So here's 3 things I'm going to submit to you. China is a command economy. The cornerstone of a command economy is having control. What is one thing that we absolutely know that they have control over right now, that they don't want to give up control over? Their currency. Exactly. You cannot be the reserve currency if you want to control the level at which it trades. Okay. Second thing, bond market in Japan, or China, pretty much non-existent. And where it does exist, let me tell you, there's no price discovery. You think the Fed is discording price discovery here in the United States? There is no price discovery in China in their bond market. Okay, so those are 2 really, really important things that suggest that it's very unlikely that China becomes the reserve currency. The final thing is that goods that are traded in the US dollar are pretty much guaranteed safe passage. So you buy something in dollars, you're transporting it across the Straits of Malaga, your ship gets hijacked. Who's going to come to your rescue? Who is the best global citizen? Is it China? I don't think so. The United States still retains this global citizen, policeman of the world role. Now, it's controversial. There's a lot of problems with it. Many people don't like it. But a byproduct of this is that goods that are transported and traded in US dollars generally receive safe rite of passage. This is an important factor in a reserve currency. All right. Looking at living longer is really great. It's not free. We have been under the illusion that it is free. It is not free. It costs money. And the bill for that cost is starting to come home to us. So again, we face this structural problem. And we may see some improvement because we may see some bending of the cost curve, and that would be huge, but it's not going to be instantaneous. So we're going to experience some problems with our debt levels and our budget deficit in the coming 3 to 5 years. unless something is done about it. We lived on deleveraging, or we lived on leverage, and now we're deleveraging. So we lived on leverage. We masked the impact of our demographics for a long time, and now that has ended. And by the way, a lot of this deleveraging isn't necessarily people paying off debt. It's foreclosures. Okay, one final thing which is kind of interesting. It's a double-edged sword. Actually, I was asking people, I've given this presentation a few times. If I said to you, what is the city with the highest number of college graduates or greater, you probably wouldn't have said Stamford, Connecticut. So there's a couple things I want you to notice about this chart. That higher concentration of people with college degrees or greater also leads to higher wages for people with high school degrees or less, right? So if you have a high school degree or less, your average compensation in Stamford, Connecticut is $107,000. That is dramatically above the US average and dramatically above the 16th highest city, which is Boulder, Colorado, with 39% of college degrees. There's a tipping point here where these incomes really go up. So this is important for municipal markets, it's important for housing markets, it's important for policy, and it tells you something very interesting about the jobs market in the US. As I said, we're experiencing structural breaks. This is something that people need to pay attention to. It may have surprising consequences for inflation, or it may have predictable consequences. That is, disinflation will continue to be a challenge. And this is a really big problem for the government, for our economy, but also for running monetary policy. Because if you have the perpetual challenge of disinflation, you are in a really tricky spot. Like then there will be QE. And the assumption is that that's not going to be the case, but it's certainly a risk that's out there. Right? This just shows the growth in the what we call the brain hubs. If you want to know more about this, Enrico Moretti from Berkeley has written a very interesting book on the subject. And if it's something you're interested in, take a look because it's a lot of really fascinating data. Okay, well that is it.